The market is currently closed for SoFi Technologies Inc. as of Friday, April 24, 2026. The stock last traded at a price of $18.32, marking a decline of 3.88% during the final hours of the previous session on Thursday, April 23rd. While a nearly 4% drop might suggest a company in distress to the casual observer, the reality under the hood of this digital banking giant tells a far more nuanced and arguably more aggressive story than the price action alone reveals. Most investors are looking at that $18.32 figure and worrying about the immediate volatility leading up to the April 29th earnings call, but they are missing the massive fundamental shift that just occurred in the last 48 hours. SoFi just became the first nationally chartered bank in the United States to integrate XRP into its core deposit architecture, essentially turning a traditional banking license into a bridge for the digital asset economy. This isn't just about offering a new coin for retail trading. It's about SoFi positioning itself as the settlement layer for a new type of institutional flow that its competitors like Fidelity or Schwab are still treating with extreme caution. The expectation in the market right now is one of nervous anticipation. After a massive rally that saw the stock climb nearly 70% over the last year, reaching towards its 52-week high of $32.73, the current pullback to the $18 range feels like a reality check. Many traders on the Robinhood app or those using a SoFi active investing account are questioning if the fintech premium has finally evaporated. The common narrative is that SoFi is a high-growth neobank that is finally hitting the ceiling of what its lending business can support in a higher-for-longer interest rate environment. But the reality I want to challenge you with today is that SoFi is no longer a lending company. It has successfully transitioned into a technology infrastructure provider. When you look at their technology platform segment, specifically Galileo and Technisys, you aren't looking at a bank. You are looking at the plumbing of the entire fintech world. Every time a competitor's customer swipes a card or moves money through a smaller neobank, there is a high probability that SoFi's backend is the one processing the transaction and collecting a fee. Looking at the recent stock movement, the volume has been telling a story of institutional repositioning. On the last trading day, we saw over 51 million shares change hands. While that is slightly below the average daily volume of 62 million, the price action remained heavy. Institutional ownership currently sits around 38%, which is a significant jump from where it was 18 months ago. We are seeing large players like Vanguard and BlackRock maintain or increase their stakes while retail sentiment fluctuates. There is a clear tension here. The smart money is looking at the $825 million net income guidance for the full year 2026, while the fast money is panicking over a 3% intraday swing. This is exactly where the gap between expectation and reality creates opportunity. If you are watching Nvidia stock or Apple stock, you are used to high multiples, but SoFi is currently trading at a forward price-to-earnings ratio that reflects a massive growth expectation. The bears argue that this $18.32 price is still too expensive for a bank, but the bulls argue it is a steal for a software company. Let's talk about the institutional activity we've seen in the last 90 days. While there has been some insider selling, notably from directors like Steven Freiberg, who trimmed a portion of his position near $20, CEO Anthony Noto has remained a consistent buyer on the open market. In March, Noto added nearly 29,000 shares at an average price of $17.32. When the person with the most intimate knowledge of the company's internal numbers is putting another $500,000 of his own cash into the stock at these levels, it sends a loud signal to the market. It suggests that the internal projections for the upcoming Q1 earnings call on April 29th might be even stronger than the consensus estimate of 0.12 cents per share. If SoFi beats that number and raises its full-year outlook again, the current $18.32 level will look like a distant memory. Beyond the daily price swings, we have to look at the macroeconomic pressures. The Federal Reserve stance on interest rates has been a double-edged sword for SoFi. On one hand, higher rates allow for better net interest margins on their personal and student loan products. On the other hand, it increases the cost of funding and can lead to higher default rates across the broader consumer base. However, SoFi's secret weapon is its high-quality member base. The average SoFi member has a six-figure income and a credit score well above 700. This is not the subprime lending pool that many investors fear. This is the affluent millennial and Gen Z demographic that is traditionally the most profitable for banks, but the hardest to acquire. SoFi is acquiring them through a financial services productivity loop, where they come for the high-yield savings and stay for the individual brokerage, the SoFi credit card, and the student loan refinancing. Comment below how many shares of SoFi Technologies you currently hold and what your average cost basis is. I'm curious to see how many of you are still holding from the 2021 highs versus those who have built a position during this 2026 recovery. To understand why the stock is behaving this way, we have to look at the three pillars of their business. First, there's the lending segment. This is the old guard of the company. It's what pays the bills. With a deposit base of over $37 billion, SoFi Bank can fund its own loans rather than relying on expensive external warehouses. This gives them a massive cost advantage over other fintechs who have to pay market rates to get the cash they lend out. Second, there's the financial services segment. This includes the SoFi mobile app features like checking, savings, and the investment platform. This segment is finally profitable on a contribution basis, which was the big aha moment for Wall Street last year. It proved that SoFi could actually make money from providing basic banking services, not just from high-interest loans. The third pillar, and the one that truly justifies a higher valuation, is the technology platform.
By owning Galileo and Technisys, SoFi has created a vertically integrated stack. They don't just use a banking platform, they own the platform and rent it out to others. The recent integration with FedNow through Galileo is a massive development. It means SoFi is now a primary participant in the US government's new real-time payment rails. For any other bank to get this functionality, they might have to pay a third-party provider. SoFi is the third-party provider. This creates a recurring high-margin revenue stream that isn't dependent on whether or not people are taking out new mortgages. It's a volume-based business that grows as digital payments grow globally. The reality of SoFi's situation is that it is currently being attacked by short sellers who claim the company is a financial engineering treadmill. They argue that the profits are a result of accounting choices rather than organic growth. This is the tension that keeps the stock at $18 instead of $30. Investors are waiting to see if these profits are sustainable. The management team has responded by guiding for a 72% increase in net income for the full year 2026. That is an incredibly bold claim for a company already generating $1 billion in revenue per quarter. If they hit that $825 million net income target, the financial engineering argument will likely fall apart, and we could see a massive short squeeze as the market re-rates the company as a true high-growth tech play. When you compare SoFi to its peers, the difference is stark. Companies like Upstart or Lending Club have struggled because they don't have a bank charter. They are at the mercy of the capital markets. When investors get scared, they stop buying loans, and those companies' revenues dry up instantly. SoFi, by contrast, can just hold the loans on its own balance sheet and collect the interest. This stability is why we've seen the stock outperform the broader fintech sector by over 50% in the last 12 months. Even with the current pullback, the trend line is clearly up. Looking toward the future, the catalysts are numerous. The expansion of the big business platform, which allows enterprises to manage both fiat and crypto in a regulated environment, could open up an entirely new revenue vertical. If SoFi becomes the preferred bank for the growing number of companies operating in the blockchain space, the deposit growth could be exponential. Furthermore, the potential for a dividend or a share buyback program in 2027 or 2028 is starting to be discussed in analyst circles. For a stock that was once considered a speculative SPAC play, the conversation shifting toward capital return is a sign of extreme maturity. The risks, of course, remain. A sudden and deep recession would test the credit quality of their loan book. If unemployment spikes among high earners, even SoFi's affluent members might struggle to pay back those personal loans. Additionally, regulatory scrutiny on fintech banks is increasing. The CFPB has been active in looking at how digital banks handle customer disputes and data privacy. Any major fine or restrictive new regulation could dampen the growth story. However, SoFi's management has been proactive in their compliance efforts, often moving faster than the regulators to set standards for the industry. In summary, the current price of $18.32 reflects a market that is unsure which version of the reality to believe. Is SoFi a bank that is currently overvalued, or is it a technology powerhouse that is currently on sale? The expectation is that the upcoming earnings report will be just okay, but the reality of their recent product launches and institutional crypto integration suggests they are building something much larger than a simple neobank. We've seen the stock climb from $15 to nearly $20 in the last few weeks, and this minor retreat is likely just the market catching its breath before the next leg up. The contrast between the short-term volatility and the long-term structural advantages of their technology platform is where the real insight lies. If you are looking for investment help or researching investing sites, you have to look past the intraday noise and focus on the operating leverage. As SoFi continues to prove it can grow revenues at 30% while expanding margins into the high teens, the smart friend advice here is to watch the April 29th numbers very closely. The gap between what people expect and what SoFi is actually building is wider than ever, and that gap is where the alpha is found. Keep a close eye on the volume and the institutional buy-in, because that will be the ultimate indicator of where the stock heads as we move into the second half of 2026. Stay grounded, stay objective, and always look for the reality behind the narrative. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.